Hello everyone, it's Davide here and welcome back to Learning Finance. So today guys is Thursday at the moment I'm recording this video, and just yesterday at the end of the day we had that the US passed the bill that could delist Chinese companies from stock markets. Now, I have done previous videos on Tuesday where I was basically explaining you that thing, and then Wednesday, so yesterday, we had the vote, okay? And obviously they passed it. I already told you that this thing can go without any problems until the end. So when Donald Trump will sign this document as well. So in this video, I'm gonna tell you a little bit about this, and I'm gonna show you what I have done yesterday during the dip. So, as always, the only thing I ask you guys is please leave me an early like. It's very important for the channel and I really thank you for it. And subscribe to the channel so you don't miss any new updates. Let's begin. So, the US Congress passed a bill on Wednesday that could close US stock and money markets to foreign companies that do not comply with US oversight of financial audits. It came as part of a bipartisan push by lawmakers to put more economic pressure on China. The Holding Foreign Companies Accountable Act, HCAA, was passed unanimously by both House and Senate and will now be sent to President Donald Trump, who is expected to sign it into law. And the new rules will mandate that any foreign companies listed on US Stock Exchange must comply with accounting requirements stipulated by the US Securities and Exchange Commission, SEC, while barring any foreign company from being listed on the US exchanges if its financial audits cannot be inspected by the SEC watchdog. The SEC, responsible for enforcing US securities laws, has long struggled with Beijing over inspected audits of Chinese companies listed on US markets. In 2013, an agreement between US and Chinese auditing authorities was intended to streamline a process allowing an SEC auditing watchdog to access audit documents of Chinese companies listed in the US markets. The deal was initially welcomed as a breakthrough for financial transparencies. However, US officials say China has not allowed access to audits. In August, William Dunkey, chairman of the SEC auditing watchdog, known as PCAOB, said that the board has no prospects of being able to oversee disclosures and prevent accounting fraud in China. We must trust and verify, but we have no ability to verify in China. So that's the main problem. Because if you just take a look at what, for example, we are talking about Alibaba, JD.com, you see that these companies has an external auditing firm, which its purpose is to review and verify what the Chinese accountants are saying about that. And in case of JD.com, the company since 2019, they have this one, which is Deloitte Touche Tomatsu. So I don't know how do you pronounce this correctly. However, it is just known as Deloitte or Deloitte, or depending on where you're from. Anyway, this one. And basically, if you just copy and paste this on the PCAOB, you realize that Deloitte, as well as PwC for Alibaba, they are already registered as PCAOB accounting firms, okay? So they already respect that accounting policies, as we can basically see from here. However, what is the problem? Even though PwC, Deloitte, all these companies here are basically multinationals, okay? You can find them all around the world, US, Europe, whatever. What they are complaining is that the branches in China is not easy to actually have go there and verify what they're doing, okay? So that's the main problem for them, and this is what the bill is about. However, in my opinion, I don't think that this is much of a problem, especially for huge businesses like JD.com and Alibaba. Where could be the risk, in my opinion? The risk, as always, can be in smaller companies, especially in the EV sector, which is now obviously in a hype. As always, when a sector is in a hype, you see new companies that are coming out like mushrooms after it's rained. And not all of them are actually great companies, okay? And that's it. And in fact, we had just a couple of days ago the fraud of that other Chinese EV company, which was basically faking the sales by basically selling cars to itself. But once again, here, for example, if we go down, they mention again the fact happened with Luckin Coffee. This, once again, it was a company in a moment of hype because we had Starbucks, and then everyone was in hype because of Starbucks, and then boom, the Chinese Starbucks once again. But the company was below the $10 billion when people actually went in hype and start to buy everything. Like, we don't care, we just want the next Starbucks. So this is why I usually don't like hype companies. I usually don't talk about hype company in this channel because when a sector is in a hype, it's very easy that there is someone that says, well, you know what, I'm gonna try to exploit that hype to actually make some money for myself. But this is not just happening in China. This is happening everywhere. Just remember Nikola Motors, what they have done. And they're not Chinese, actually. They are based in the US. It's the same stuff. Just be careful with small hype companies. But that's not just Chinese or whatever. It doesn't matter where they're based because these things can actually happen. When you have these small hype companies that basically they are not profitable, you don't know what they are doing, but you're just buying because everyone is doing. So it seems clever to do it as well. While on the other hand, when we are talking about companies like Alibaba, companies like JD.com, those guys over there, they're not just the small hype company which is a hype now and then everyone forget about it. These are the number one and the number two e-commerce in China, which is huge. Now, if we just take a look at that, this is from Statista.com. We realize that at the moment, the Chinese e-commerce market is projected to be around 1.1 trillion this year in revenue. And then basically we realize that the revenues is expected to show an annual growth rate of 7.9% in the next 5 years. So this is why I'm very bullish on Chinese e-commerce, because this is huge, and the expected revenues in 2025 is 1.6 trillion in basically 4 years, because 2020 is finished. That's impressive. This one is gonna be higher than the US e-commerce market. The growth, these numbers are real, okay? It's not an EV company that just fakes the sales of 3,000 cars, which is pathetic. These numbers are real. You cannot fake $100 billion in revenue in 1 year. You cannot fake $35 billion in revenue in a single quarter, okay? So what have I done? I have actually bought yesterday on the dip JD.com. So I have added more stocks at $83.99, which is basically, if you just go to see my fundamental valuation of JD.com, which is here, I'll leave you the link down in the description, it's 37.41% lower than basically my fair price that I estimated. Okay, so that's the reason why I have added more shares, and I have also added a little bit of Alibaba stock. Now my total position in Chinese stocks is now 16% of my portfolio, and I'm pretty confident about holding that risk because I don't look at tomorrow, I look at the long term. When I buy a stock, I always think about 5 years. Okay, then they can be more or they can be less if the stock really explodes in a way that I didn't consider. But usually when I buy something, I always think at a 5 years time. And why I am bearing the risk to be invested invested in China, because I'm not buying hype stocks. I'm buying the number one and the number two, basically the top e-commerce over there. And when we take a look at JD.com specifically, we have a company with the same business model of Amazon, which is projected to reach $137 billion in revenue in 2021, and this is actually lower than the market cap right now. So if these short-term problems and issues with the listing policies and stuff, if this thing go away for basically the top Chinese companies, I cannot guarantee for hype stocks, but for this one where I'm very confident about it. And this company here, if it continues to grow with the projections of the entire sector that we saw, with the projections of the Chinese economy, where I'm pretty confident that a company like JD.com can go 3x at least in the next 5 years, okay? And the only problem is this kind of continuous issues and tensions, as well as the fact that China should probably try to be more open with the world. If they are able to be more open, they are able to actually build confidence in foreign investors to invest in China as well. I think that these companies, they can really benefit from it. So I remain positive. This is the end of the video, guys. I hope you find it interesting, and just leave me down a comment below. Tell me, what do you think about it? Do you remain confident or not? Are you scared or not? One thing that honestly I really like is that if you look at 13F's documents, and you are gonna see what institutionals have done with Alibaba stocks and stuff, they didn't sell not even a single stock, and that's very positive. Okay, just retailers, investors are actually freaking out right now, very scared. They are selling stuff, but the institutionals, you find the biggest banks in the US. Okay, you can find Morgan Stanley, JP Morgan, BlackRock, which is biggest asset management in the world and stuff, and all of them they didn't sell not even a single stock of Alibaba. So that gives me even more confidence about the long term of these companies. Okay, so that's it, guys. If you find this video interesting, please leave me a like, and I thank you for it. Subscribe to the channel, leave me down a comment, tell me what do you think, and as always, guys, have a wonderful day.